Well, the markets a gap down this morning, continued lower throughout the day, finished at the lows of the day, a little off it, but mostly at the lows of the day today. And now overnight trading is down another 3% after President Trump's live address here from the Oval Office tonight. Pretty significant declines. Of course, the overnight trading, not as much volume. And yesterday's move was interesting in that it didn't contain a lot of other there wasn't a big flight to safety yesterday as even bonds were kind of selling off a little bit and yields rallied. So what do we make of all of this? How, where's the support? Where's the floors? I'm going to break that down. I'm going to take a look again just to look at other instances that were similar to this in terms of volatility and what we can gather from them in terms of what kind of moves to expect, because that's the issue here. We don't necessarily have to avoid these types of moves. We have to stay small, keep our risks small, but take advantage. So that's what we did today in class, in our trading room, and we'll continue to do tomorrow. But I'm going to show you in today's video kind of what drives my expectations into making those types of trades. With one as an example today that we'll take a look at. So let's go ahead and get started. Today is Wednesday, March the 11th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the Market Forecast Indicator. You can see that here we are, two down days or two out of three this week. Dark pink shading, red line. It's going to be that way for a long time. We're gonna have a red line for a long time. We're not gonna get above that line to make it yellow or green for that matter anytime soon. We can get light green shading. In fact, we just barely had light green shading, so that's a possibility, but not the dark green. If we do get the dark green, it might not even be enough, considering how bearish we are and hitting to a lower low here. You notice we did hold yesterday's long lower shadow for a close. Now, as we speak, if you look over here on the right, the futures are open and we're down. We're popping up a little bit off of the lows, but we're down 3% already. We were down close to 4%, a little bit over 4% at one point here. The things have been changing as I've been working on the videos, so different things going on here tonight. Big move, obviously. Now you notice a higher low in the intermediate line, lower lows, obviously here. 275 is an important level for support. 265 is an important level for support. At least on SPY on a volume profile. If you see here's we're getting close. Just to kind of show you what that looks like from a support level here. 270, and we're looking at long term. 275 is right in this area, right here at the kind of the biggest part of this. 265 is the bottom end. So if we can't hold the bottom end of this, then again you're looking at a little bit of support at these lows, but not much because we went down so far so fast, down and up. Really, it's this area that's your support level. That's where we were holding a low point before we had that big 1 week decline essentially, and then we rallied up really sharply. So 265 is important. If we don't hit 265, then we hit, we head down to 201, and that would be obviously a significant decline from this high point of 300, and we're looking at that point of about 39% drop in equities. If we get down to 210, 38% drop in equities. Excuse me, not too common to get that big of a drop, but this is the fastest drop to 20% that we've ever had. Now, if you notice here on the zigzag that we are flirting with that key 20% mark. If you look at it here and we go back the 15 years, this 20% marks an important level. If we can stay above 20%, remember this is on a closing basis, and as much as we are down now, we're popping up a little bit, but as much as we are down now overnight, what really matters is when the volume comes in the morning and whether we stay down. If we close down below 20%, then you can see, we were down 45% during that recession. And then if I go back to the other recession, well, kind of extended bear market, we hit below 20%. We rallied 19% off of that, failed at the 200-day moving average, and rolled over. So it's that 20% mark. It doesn't necessarily mean that, okay, now we're going to fall 38%, down to 210, like I mentioned before. But what it does mean now is we are more likely than not headed towards a longer move to the downside, like an extended death cross environment where, very similar to, when you get the, as I mentioned with the VIX, when you get the VIX up to certain levels, then you're likely to get the market sentiment line to fall below 50. And we're working our way down there. It actually already is in the Russell 2000. The Russell 2000 is worse than the S&P. Has really been, sharply down lower. It's into this area. You can see that, we got dark pink shading now on the weekly chart with the red line. See the SPX doesn't have that yet. Just barely is getting it, actually. Dark pink shading and the red line. You can see when you get that on the weekly chart, it's pretty significant, right? If you go to, obviously when you were in the bear market mode, the recession modes, when you're not in recession, we were really close here in 2011. That's what a lot of people are comparing this to. We had a little bit of red pink shading. Same thing with 2015 and 16. We had some pink shading and red lines. So those are the two closest periods that we were to recession. A little bit more over here in 2018. If you look at the monthly market forecast, then you can kind of see again, we have the near-term line falling. Now, granted, we're not done, right? March is still a couple weeks, 3 weeks away, 2-3 weeks away from finishing. So we might not finish down here at this low point. But you notice when the momentum line has gotten to these lows, we've had some pretty bullish moves. When we get the yellow and or pink lines patterns here, we've had some pretty big moves. Now, not always, right? So you can see you get yellow and pink, yellow lines and light pink shadings before the big turnovers. See the recessions, you get the dark pink. So that kind of puts in the context here. This 2-month move that we've had, so the log scales on. So, you look at this 2-month move and you look at that Q4 move in 2018, you look at this move in 2011, you can see we had 3 negative months going into August of 2011. And then September we finished near the low points. And even then we still didn't get below that monthly moving average. It would be a 30-month moving average. So obviously we have been bullish for quite a while. We had a nice little bounce, here off this market sentiment low point here. We had the market sentiment low was actually November of 16. So right here is where this market sentiment rally started. But early in, when 2015, beginning of 2016, we were we had this long-term bullish pattern. So if we end up kind of fiddling around here by the end of March, whether we go up or down, but depending upon where we close the end of March, that's a pretty bullish pattern, but it can also precede a significantly more bearish pattern, right? We got a pattern like this in early 2008. We failed without getting, failed the 200-day moving average and rolled over. We got this in early 2001. We failed at the 200-day moving average in May of 01, and then we had the breakdown. So right now we are in death cross environment, right? So we are here in death cross environment, or about to be in death cross environment. We're down here at that 62% Fibonacci level. 2571 is where 2571 is where the 78% Fibonacci level is, kind of like make or break level. But this is kind of an important level too. I showed you before this move here. We also broke below the 62% Fibonacci retracement level, only to have it come right back up, right? So if I show that zigzag chart again and go out long term, right? So this move right here, it broke below the 62% level just briefly. You can see it kind of, you can't really see it as well, but you can see it. It was just one day. It was at the beginning of the week, obviously, because we ended up with a long lower shadow. But it was right where my cursor is. So we might have one day where we break below the 62% to really get people going, and then bounce right back up on Friday if tomorrow ends up being that day. And again, they kind of show you what that looked like here. I need to go back, don't I? So go back 5 years and keep it on a daily. So you can see that was the day. It was a Monday after Christmas Eve. Actually, it was a Monday after. It was Christmas Eve. It was a Monday after options expiration, so coming off a weekend. And then you can see the Tuesday. That's the big move we had the next Tuesday. We rallied really sharply higher. So, obviously we'll see what ends up being the case here. Today, if you look at the percent moves here, and you see where the volatility is, this volatility, the historical volatility, so the light blue, that obviously we know where the VIX is, but the light blue line is as high now as we got in 2011, and that ended up being the peak of the volatility on a historical basis. Obviously, we got more above that in 2008. At the end of 2008, we actually hit about this level in early 2009 when we hit this low point and started the run. We never did hit this level in 2008. So this is a pretty volatile period, more volatile than we saw even during the Great Recession. The VIX is obviously higher, but if you look at these moves over here, at some point in time you get these consecutive down moves, and they're followed by big up moves. So a big up move, we're not going to have a little up move like one of these. It's going to be one of these. The bigger they are to the downside, the bigger they are to the upside. So again, if and when we get them, don't be suckered in by them. Look for us to hit support on these lows and to bounce back up towards resistance. And where can that resistance be? Well, if you look at the 3 green arrow chart, look how far below the 8-day moving average we are. In fact, if I were to do the PPO here, and it won't let me do it on the exponential moving average, but if I come over here and you look at how far below the 30-day moving average we are, and then we'll look at the 8-day in just a second. So if I were to come over here, just to kind of give you an idea of where we finish the cash index. Obviously, remember the futures is down already overnight, but this is where the cash index finished below the 30-day moving average. They kind of give you an idea. There's 2015. We weren't even close to that low right there. There's Christmas Eve, and you know how bad that was, and that didn't get this far away from the 30-day moving average. And then you look over here to 2011, and that almost didn't get there. Last time we've been this far was the worst of the financial crisis. And again, in early 2008, we didn't get there. So again, it's not necessarily a move that starts a recession. Here's 2002, and again, we got down this low at the end of the recession in 2002, and a little bit there on 9/11, and we know how bad that was. And you can see the move sharp up to the 200-day moving average we had there. The same thing over here. We had sharp moves up after the big moves down. So expect a sharp move up. Just don't expect a sharp move up, towards a 200-day moving average. Just don't expect it to break through resistance and head back up higher again. It's just we're going to eventually go up. We're going to eventually come back down and retest these lows, if not down to 265. Here you can see by the end of the day today. Obviously, when we look at the intraday range, you can see a wide range. I mean, we're talking like 40 plus 30. So we're looking at 70-point range, which is nearly, well, it is more than 20%. So the 4-week range is 20% of the 4-week high point. That is one of the biggest ranges we'll see in a long, long time. That's a tremendously huge range there, and tends to be, again, pretty bullish when you get ranges that start to exceed even just 10% in 4 weeks, much less 20% in 4 weeks. But again, how far, if and when we do bounce, how far up? Again, don't expect us to go back up to 336. If you have any trades where you're targeting these highs in the next couple of months, they're not going to hit it. A lot of the trades that we've done in my directional option strategies class here this week, we've been looking at now, for any directional trades trying to take advantage of these moves, we're looking at June, right, to give people time, to give the market time to go up and down, up and down, up and down, before eventually potentially getting going back to the upside again off of these low points. Again, once we get going, once we establish the low and then we go up and down, up and down, up and down, it will be a couple of months before we get going. And when we do get going, we will be well off of these lows. That's kind of the idea behind these trades. Anytime you get a move towards these lows, we can take advantage with really small risk, but really directional trades that have a lot of reward potential. And then you just give yourself some time to let the volatility work itself out in the meantime. So that's kind of what we were looking at. And again, when you have that big of a range, and then of course, we all know the volume and the trading range. You see the volume. There's the trading range is easily up above, but you have to include the gap, right? There's another gap that we still need to fill in. And again, that's another sign that I'm not too worked up about today, because we got to fill in that gap. And we got to finish filling in that gap. We started to. We still got to finish that gap, and we didn't finish filling in that gap either. So we got a lot of gaps here that we still have to fill in. We filled in this gap, and like I said, we partially filled in a few of these. So we still got gaps to fill in. In fact, we still even have that one from last Thursday to fill in. So that one's going to be a little bit harder to do, at least in this short term. But you can see how these gaps filled in, and when things were really bad initially in China, with that move right there, we filled in those bearish gaps. So we're going to get another move kind of like that towards 300 and fill in these gaps before we get some resistance again. Very decent chance that's a possibility that could happen. All right, but if you take a look at the total volume, so we looked at the range here, the close 288.42, the high 281.94. So we're looking at about 7 points, roughly, almost 7 points added on to the 11. So we're at 18 points of a range. The volume at 256 million. Again, it's interesting. The volume's picking up, but the price is dropping. So it's not, the dollar amount might be very similar. You look at the this price, and again, we are well above 3%. And if you go back again on an ATR level, we're now eclipsing where we were in 2011, where we just barely got to 3% there. We are now approaching 2008. Now, granted, I don't think we were going to get to 7.5%, but in 2009, when we hit this low point, we were at 4%. We hit 4% there. And of course, you can see in 2002, when we ended that bear market, see, we hit 3% a few times here, but this was a 4% move up to 4%. And I think there's a very good chance. 4% right now of 274. 4% is 274.36. 4% of that is 11 for the ATR to get to 11. Well, the ATR is at what, 10.33. So, and we're getting multiple point ranges, 18 today when you include the gap. So I think we're going to really easily get to 11. And of course, when you go back to the last time we got to that high, back in 2002, so right here, you can see, by the end of 2002, how much it had come down. We had really settled down there, and the volatility really ramped. The relative ATR came down. Still really pretty high at 2. It wasn't until we really broke 2 that we really got going out of that bear market. So that's kind of what we're seeing here right now. Finally, let's take a look at the VIX, and the VIX shows a very similar pattern, very high levels, but you notice we're not ramping up here anymore, and we can't go as far back on the VIX. Let's just go back as far as we can here. You can see we go back to 2007 and 2008 as far back as this data has for the VXV, excuse me. If you go back to that same July 2002, this is where we were. We got up to around 47 In September 2001, we were in the 40s. We got the 40s a few times in 2008. And then, of course, we had this move, and this is kind of where we're at right now. Again, very similar to the beginning of '09. If we end up peaking, right? If we go up to 80, then it's like the financial crisis. But this is not a financial crisis, a health crisis that's having an economic impact, right? So the question is, are we going to get to 80 again? And that's highly doubtful. But we saw what happened in early March and the type of returns you had a year later from when the VIX spiked back up to 50 some odd and stayed there for a little bit. So it stayed there in March for a little bit of time, right? When you go back here, we hit back up here in January. It wasn't until we were still up around the 50s in March before we finally came down. All right, now let's take a look at the sector rotation here. So give me 1 second to load up the asset classes. You can see we did not get a big bond move today. So that was kind of an interesting development. As bearish as we got in stocks, we didn't get a really bullish move. So it kind of shows just how bullish we've been. Again, year to date here, you can see stocks were up pretty good. But year to date, this is a 1 year chart, isn't it? 1 year? Yeah, 1 year chart. Stocks were up 20 some odd percent, but not all stocks. Small caps were really lagging. So were emerging and international stocks. Now they're down on a 1 year level. And again, I go back to showing you how we've been performing since I believe the market peaked, and we've been in a bear market since this January 26th of 2018. You can see crude oil is down 50%. Now look at IWM is now down 20% off of those January highs, even if the market itself is only down 3% below those highs. So that's a pretty significant decline. If you go to this October 3rd peak here, when crude oil peaked, that big move, bonds kind of bottomed out at that level a little bit later, but they kind of bottomed out that level. So if you go from that level, and that's kind of another peak of that bull market and the start of the bear market, you'll see here, again, 33% from that high point in gold and long-term bonds, 56% drop, 23% drop, and S&P is down 6% from those October highs. So, and you can see even real estate was doing really well, and it dropped down along with equities, with basically all different risk asset classes. The dollar not nearly up as strong. It was more up. It had a really strong 2018, where a lot of its strength came. So again, you can see how bullish risk safety has been, mainly because of the trade war, but it's pretty bullish safety trade. Now, obviously, with the coronavirus here adding this leg, it just kind of basically puts everything into the type of market that we kind of expected that they would be in. If you look at the 10-year note, the 10-year yield, it's actually rallied up these last couple of days. It's back up to 82 basis points, so it's not quite at 1%, but it's made a decent move higher. But obviously has a long ways to go. I mean, looking at the monthly chart, you can see it now. It's getting close to forming a pretty long lower shadow if it ends up being that. We typically don't get monthly long lower shadows. But that would be a relatively bullish sign considering how bearish we've been on this monthly basis. And of course on the weekly chart, depending upon how we finish, we have the potential for a what would that be, an ace and not a piercing line candlestick pattern there, depending upon where we finish, especially if we finish up towards 1%, coming off of multiple clusters on this little drop that we've had. And for when you look at other risk trades like crude oil, also giving you a weekly cluster. Here's the monthly chart for crude oil. As bearish as it's been, down to $31. That's about as low as it got here during the financial crisis, as well as when it had its really bearish run from mid-14 to here. That's kind of the low point that it hit. So we're kind of hitting some pretty significant lows on crude, and we'll see if that ends up playing out, if we end up kind of holding at those levels. Here, let's see if I can go back a little bit longer. Crude oil. So right in here you can see the breakdown that we've had. This is on the weekly chart, mind you. Go out to this 10-year chart. You can kind of see there's that, again, that 2016 low point. I had to go back out to 15 years to get to this monthly chart. And that's as far down as it got. So very, very significant levels to the downside for crude. And we'll see if that, what ends up happening there, if there's any stimulus from a producer standpoint that can lift prices. It's seeming like that's kind of what would be needed at this point. Again, if we get a long lower shadow on the monthly chart, you see how bullish that can be when you've had these big downward moves. And we'll see how March ends up shaking out and how bullish that would be here. Now, it doesn't mean that we can't trade within those in that range again, right? You can see multiple lower shadows, multiple months. These are monthly candles. So you had multiple months. So we get one, don't be surprised if we don't follow it up with another one in April. Some down and ups, right? Some ups and downs, before we really settle down and get going again. Let's take a look at the sector moves. And look at the 12 grid for all the sectors. I mean, it is dark pink shading, red lines all over the place. We're not going to get green lines anytime soon. In fact, if I were to switch this over to like a weekly chart, well, it's not going to let me do it and still show you the trend. If I go to this is how I'm going to have to do it. I mean, you can kind of get an idea of, well, it's not going to show up as well. But you can get an idea that it's pretty bearish all across the board here, and not just on the sector rotation, but also on the global markets. Again, you look at we didn't check this out earlier, but you take a look at all the major economies, all dark pink shading, all red lines. I mean, it's when people talk about diversification doesn't matter in a market like this, right? It doesn't matter how diversified you are. International. All that matters is that you're diversified in terms of equities and fixed income. Because when it's all equities, it doesn't matter what sector, doesn't matter what area of the world you're in, international, US, domestic, large cap, small cap, they're all dropping. And they're all dropping really, really sharply. That's a sign of, kind of capitulation. And when things bottom out, is the more correlated you get, that's a sign of bottom. It's a contrarian indicator, actually. So it's a good sign that eventually, we all move together, because then you all bounce together, and then the correlations start to work away as you get going again to the upside. Let's look at the comparison chart here for the sectors, and you can see, and this is again a 3-month chart. If you look at the 1-year chart, it's not so bad, and that's part of the reason why we've been able to hold up some gains in the SPX, is because of the technology sector and how bullish it's been. But if you just look at since, what would this be? We're going to remember this date because it's going to be the high point that we point to. This would be February the 19th. So we have to go to February the 20th again here. So basically the last 4 weeks or so, you can see there's your safe haven areas all holding up okay, 10% plus declines, not very much. You can see the S&P is down 20%, 1904. You can also see too that your financial sector has been hit the hardest, industrials, materials, so again kind of cyclical areas, and then finally the energy sector is just down 38% in 4 weeks, or whatever that this is. That's not very much of a move, and we talked about before over here when we were rallying, was it over here when we were rallying, it was the safe haven areas that were rallying. We weren't buying into that, right? And you can see they've been able to hold up, and that's okay. It's okay for them to kind of hold their value, almost half the losses of what the broad market as a whole, and less than half the losses of what you're seeing in some of these other cyclical areas. Alright, so for our trade idea of the day, I wanted to take a look at Facebook here, and you can see, here let me go to Facebook, And I want to take, obviously this is what, I mean, a lot of charts look like this. But I want to take a look at the 5-year chart. And you can see this is a relatively important level, especially if I go to the Bollinger Bands for Facebook. Again, on the 5-year chart here, you can see this is like the bottom end, this 160 area. I mean, that's the bottom end of this big node. I mean, there's where the point of control is. We're down a little below the point of control, but the point of control is not one big long individual line. It's kind of a big chunk here. And 160 is kind of the bottom end of that chunk. If we don't hold it, there's, even then you can see that we kind of stair step its way down. So it's not going to be necessarily a free fall like, say something like RCL has been. Once you broke below it, it was a free fall. Below this, well, it was the big point of control. Now we've really broken down. I've been able to take advantage of that with the trade that we made in our directional options strategies class over here, and it just has continued to work its way down. But with Facebook, obviously you've got an extremely oversold. When you look at it again here, and you look at it, change this to how far below you are below the 30-day moving average here. And then put it on the daily chart. We're down 15%, and that's a pretty significant low point to be below the 30-day moving average. You can see that's how far we got in March of 18, when it also dipped pretty sharply below the 30-day moving or 200-day moving average, like it's doing right now. We got this far below, and then we made a strong little rally here. So that's kind of the idea behind this trade. Is like, okay, well, if we do continue to fall, we'll give it to 160, and that we're going to look to sell the 160 put. Let's go back to Facebook here. We're going to look to sell the 160 put, and we're going to buy the 155 put. You can see what that does for us here. Is it gives us the opportunity to rally, if we do bounce quickly. And that's kind of the idea behind this trade, is if we can bounce quickly, we can get 50. We're trying to go for $420. I don't want to lose $420 or more than that. So if we fall below 160, I'll be down $242. And you can see I've got the ability to kind of keep my loss contained within the $420 threshold. I don't want to lose the full $1,000 here. But worst case scenario, I'm able to take it. I just don't want to. But if I can get half of that, $210 quickly, on a quick bounce up here, then we'll take it. And that's kind of what the idea behind this trade is if we can get a bounce up in the next couple of days or early next week, and volatility drops pretty decently, then we can get a pretty decent quick gain on it, take it, and move on to something else. So if I'm going to trade short premium, I better have some strong support below where my strike price is, very strong support, and be prepared for quick moves, right? Lots of quick gains, and then take 50. If they get to the 50% threshold quickly, take it and move on to something else, so we can avoid the risk from the volatility of any successive move back down to retest those lows. All right, well, that does us for tonight. Again, you heard from me. Now I want to hear from you. Use that link right there popping out in the top right corner of your screen. It opens up a link. Takes you to our Market Outlook forums on marketscholars.com. Open up a new thread with any questions or comments you have about today's video. Post it there. Again, thanks for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon down below. Comment on our video. Follow me on Twitter for more content between the videos. And join our community at marketscholars.com, as well as our Facebook group that we created. Have a great rest of your Wednesday evening, everybody, and we'll see you all tomorrow.